Well, good day, traders. Chris Weston here, Head of Research at Pepperstone. So we're back once again looking at all facets of the gold market because they are absolutely fascinating at the moment. If you look at the backdrop by which gold is working in, the little different components are very messy and actually quite confusing to an extent. And we're just trying to understand what that means for the gold market and the investment case behind it. I just want to take a moment to talk about the volatility because it's extreme. I mean, I think anyone who's in the market will testify just to how extreme it is. You have to be in front of the screens as much as you can. That's where your disadvantage is. If you can't be in front of the screens, you're going to see 2-3% moves in a heartbeat. So being able to react is your advantage at the moment in these markets. Being able to look at your exposures and being able to react to price moves, add to price moves, or take away from price moves, I think is exactly what we'd be seeing in trading markets at the moment. You have to be trading with wider stop losses. There's no doubt about that at the moment. You have to be taking more risk on. But of course, in that situation, you need to look at your position size accordingly. If you're taking more risk, your position size needs to be minimal in this market at the moment. If we take gold in US dollar terms to start with, you've seen that move through 1689, which was the 24th of February high. We traded above the figure. We got to 1703. It didn't last particularly long. Traders were happy to fade there. And we're now just sort of oscillating around the 5-day exponential moving average. It looks pretty whippy. People are trying to understand where to go from here. And if you look at the initial two situations, one is what's happening with the US dollar. The dollar's started to find a bit of love in the market again. It had its biggest one-day gain overnight since 2016. And we've seen a rapid repricing of the real yield market. If you have a look at 5-year inflation-adjusted treasuries, for example, they got down to a recent low of negative 84 basis points. Now, who doesn't want to own gold in an environment where real yields are that deep? And you've seen a situation where gold obviously has no yield, and that, in effect, looks like yield in itself. But there has been a bit of a reversal playing through. I say a very aggressive reversal because they're now trading at negative 11 basis points. So the fact that gold's trading where it is at the moment is actually quite bullish in itself because you've seen such an aggressive move higher in that negative yields across 10s and 5s that gold probably could be a little bit lower in that capacity. But what we've been seeing is, from a fiscal level, a fairly clear shock and awe response to what we've been seeing from this economic fallout. People are modelling a recession in the US, in Australia, Japan, Europe. The question is what does that recession look like? Is it going to be something mild where people don't necessarily feel it too badly, or is it going to be something that's far more protracted that makes people question their level of employment, their job situation, and then obviously they hold off from discretionary purchases? So I think the market is probably pricing in a recession. The question is what does that recession look like? Something mild or something far more deep-reaching that people talk themselves into a much worse situation? And that's what we're trying to understand at the moment. So the governments have really come out firing and tried to stave this one off. Donald Trump's proposed a payrolls tax down to 0. It's going to be a difficult one to get through, and he's made it very political by saying that this wants to push this through after November election. So he's effectively politicising the virus in that capacity. We've seen the Italians talking about a 16 billion euro stimulus, another stimulus for the virus in itself. Here in Australia, we're talking 10 billion stimulus from Scott Morrison to be announced fairly soon. RBNZ or Adrian Orr talking about everything being on the table. He doesn't expect to use it, but they're talking about intervention, quantitative easing, and other aspects as well. And you can go into the ECB, you can go into other facets as well. People, both on a monetary policy and also from a fiscal perspective, are looking at supporting this situation pretty entirety. So we have seen a strong rally in the dollar on the back of that. You've seen the S&P moving up. And what we've been seeing is that the dollar in itself has been influenced by what's happened in the S&P. Makes sense to me. We saw the S&P drop 20%. That's obviously representing a fairly clear tightening of financial conditions. Credit has been very much at the backbone. Energy's been, and oil markets have been very much at the backbone of that as well. But as equity markets have fallen, credit spreads have widened, specifically on high yield, you've seen a situation where the dollar's gone along for the ride, and you've seen that dollar weakening now. So the fact that we saw the S&P up nearly 5% has also caused a little bit of a repricing in the rates market, but also a fairly strong move up in the S&P, and that's way to an extent on the gold market. So we are watching what's happening in the S&P. If you're trading gold in dollar terms, do keep an eye on what's happening on the S&P, because that's going to dictate where people are trading those real yields and also the rates markets as well. So the S&P is very much at the epicenter of my world. Where does this go from here? Well, we have to see. There's a lot of stimulus being chucked to this situation now. The market was very underloved, underowned, and perhaps there's some further upside. But we'll watch the tape there. If the S&P rolls over here, then gold in US dollar terms should work quite well, and we should reclaim that 1700 level. We have our eyes on the Fed meeting next week. That's going to be fascinating, and how gold trades into that again is going to be increasingly attractive. Look, the market's pricing in 3 rate cuts. If the Fed don't cut by 3, they risk, exasperating this sell-off, this tightening of financial conditions. But if they meet the market, they'll probably do nothing at all. The market's already priced that in. So they're in a hiding for nothing, effectively. It's the other measures that they need to announce. Is there going to be cash for businesses? There's going to be swap lines, those factors as well. And potentially, could they open the door and give more clarity about this idea that Eric Rosengren floated the other day, which I think is very, very interesting, not just for equities and credit, but also for gold and for FX markets as well. And that is, if we see rates going down to 25 or down to 0 effectively, will they be able to change the Fed's mandate, change the legal system to be able to go and buy credit and also buy equities as well? And that's something that gold traders will be watching very closely as well. So we're watching the dollar. The dollar's found a little bit of a mojo, but will it last? What's happening in real yield? That real massively aggressive move that we've seen to the upside has taken away a little bit of the shine from gold in US dollar terms. Now, if you have a look at gold in Aussie dollar terms, that's where the profit's coming from. We've seen that establishment of the 2,500 level. It's moving higher. You've seen that being really like a trend and momentum followers dream at the moment. The Aussie's not finding any friends there at all. And the gold in Aussie dollar terms looks pretty compelling in that capacity. In fact, gold in pretty much every currency is, apart from US dollars, is trading near record highs. The euro gold is quite an interesting one there, because euro did so well getting up to the 115, because obviously high volatility has seen those funding currencies being sought. People have been covering those carry trades, and effectively the euro's moved up quite nicely. But of course, you've seen some dollar weakness as interest rate cut expectations have ramped up in line with what we've been seeing with that S&P news flow that I just mentioned there as well. So euro dollar denominated gold may get a bit of love in the short term. We're looking something more favourable in euro dollar denominated gold in the short term. But we've also got to look at what's happening in the options market. And for me, it does scare me a little bit just how much love there is for gold here. If I was an Australian or South African gold company, I would probably be looking to hedge some of my exposures, either by doing that through forwards, through swaps, or through what's happening in the options market. If you have a look at risk reversals, you can see that we haven't seen this sort of love for upside protection for a long period of time. If you have a look at 25 delta 1 month call volatility minus that of 1 month put volatility, we can see what we call risk reversals. You can see that calls are trading at 5.24 vols premium to puts. That's the highest level we've been seeing really since 2013. You can have a look at 6 month implied volatility in calls, again trading over 5 vols against puts. And we know that a lot of these companies, the miners, like to look at the 6 month tenor. So we know for whether you want to do that in the open market, or if you want to go out and actually go and buy put volatility or puts in the market, it's cheap to do so at the moment. So that might be something they look at the moment. That may cause the price to sort of stagnate in the short term. But we are watching what's happening in high yield credit spreads. We're watching continuing what's happening in volatility. We're watching what's happening in positioning, and we're watching what happens next week at the Fed. Will they announce something a little bit more punchy, and what will that do to the gold price there at the moment? But at the moment, what we're seeing is some pretty messy price action in gold in US dollar terms. We want to see an establishment and a hold above 1700, and gold in Aussie dollar terms probably seems to be the